All right. Good morning. It is Monday, July the 10th, 2023. We hope you had a nice weekend. It is, I don't know if you can hear it, pretty rainy out here this morning, Monday here in Charleston, but we hope you had a nice weekend. Last week, market down a touch. Okay. We got the jobs report Friday. Kind of a mixed picture. So the headline number missed expectations by a little bit, yet the average hourly earnings was a little bit higher. Okay, so kind of a mixed bag there. The services data last week was quite strong. Okay, and so kind of on the heels of that, you saw interest rates again move higher, right? And so interest rates moving higher, kind of signaling that the market is expecting the Fed to continue to raise rates. All right, so that means, again, interest rates, bond prices, there's an inverse relationship. So we see bond prices moving temporarily lower. And I know we've touched on this in the past, but kind of the silver lining there is moving forward, right? Now on fixed income, through exchange traded funds, you are receiving a higher yield, right? And then whenever the Fed does cut rates, when the economy begins to slow more, a really good chance that you would see some capital appreciation as yields fall, right? So it kind of works both ways. The other thing I wanted to highlight this morning, I thought a really well-written article by Larry Swedroe. Okay, Larry is a very well-known contributor to the finance world for many decades. I believe he's at Buckingham now, but he wrote an article I saw through the Michael Kitces website. I would encourage you to read it if you want to nerd out a little bit like we do. But really the main theme was just on the importance of global, international diversification. And so the main theme just being, why many investors fall prey to recency bias, okay? And why global diversification and keeping proper short and long-term results in the right perspective remains a very prudent strategy. Okay, so recency bias. We haven't talked about this a great deal recently, but so the recency bias. This is just this behavioral human tendency where we put a great deal of weight in kind of how we feel about things based on what's happened most recently to us, right? So as it pertains to this article, right, in the most recent decade or so, right, U.S. stocks have largely outperformed stocks outside of the United States, right? So international stocks, and the trap, and to Larry's point here, encouraging investors, don't fall prey to this recency bias. It's not going to last forever. Remain diversified, remain prudent in that strategy. And a couple things he points out, right, and we pointed out in our office as well. You just look back to what the lost decade. All right, so here in the United States, it's referred to the lost decade from 2000 to 2009, right? So for an investor that only invested in the S&P 500 here at home, you actually lost money over a 10-year period from 2000 through 2009, okay? Whereas if you had a globally diversified portfolio in that same 10-year period, you did just fine, okay? You did just fine. In fact, and I don't have the exact data right here in front of me, but it's something like, okay, so remember, S&P 500, that 10-year period lost money. Emerging market value index, same 10-year period, earned something like 250%. So same 10 years, that's ballpark, but it's somewhere right in line there. So remain diversified. The other point Larry brings up is global recoveries tend to happen much more rapidly than just like your home country recovery, right? So while he does point out, right, if the U.S. goes into recession many times, it's going to, just given how correlated the world is, many times, the globe, global economies will also go into recession. However, historically, and there's a lot of different data points that support this, once things bottom out, it tends to be the international economies that begin to rebound first, right? So before the U.S. So you see international economies rebound earlier and more rapidly, more aggressively. They get that V bottom on the recovery. So just the case to remain diversified. So again, we would encourage you to read that article if you'd like to learn a little bit. Outside of that, we received some some fun data in the week ahead here. So June inflation. Okay, so we're going to see that data. Yeah, so economists will be looking, both the month-over-month number as well as the year-over-year to see how close, we're getting down to that 2% kind of Fed target. So that'll be important. We also start to receive some of the banking sector earnings reports later this week and then into the following week as well. Lastly, we are mailing out our quarterly, the Oceanside quarterly newsletter that I write every quarter. So I think that's getting mailed out here the next couple days. So we hope you enjoy that. And fall reviews are coming up. On our end, they're coming up. We're starting to prepare for things and put things together. So we are right around the corner. That'll be here before we know it. And we will be sending out invites and things in the month or so ahead. So we hope everyone has had a nice start to the summer here. And questions, comments, concerns, please feel free to reach out. We love hearing from you. And we hope you have a nice week. Thanks.